Not only that, from 2011, we started buying properties in the upturn, which were giving us a 30 to 50 to 60% return. In 2016, we still got those properties. In 2017, it started to slow down. We were buying 5 to 7 properties a year from 2012 to 2016. 2017, we bought 3 properties maybe. 2018 and 19, couple properties. And the returns in 2018 and 19 were starting to come down to 15%, 12%, 8%. So in 2019, I'm an investor. I was still doing deals at 8%, but I saw that Isaac Chang called me and he had an $8.5 million offer on a property, and it sold in 5 days with 10 offers, and it sold for $10.5 million. And his conservative underwriting was correct at $8.5 million, and somebody bought it at $10.5 million. So if that doesn't give you an idea what market cycle you're in, then you're not understanding market cycles.
This column here, total depreciation with analysis. He's going to have $336,000 of depreciation in tax year 2019. If he did not do the cost seg study, he was only going to have $11,000. That's because he bought the building in September of 2019, so it's prorated for that portion of the year. So instead of $11,000, he's going to have $336,000 of depreciation to use in 2019. And then kind of like what we mentioned before, cost seg is all about the time value of money. It wants to keep money in your pocket, you the smart businessman, you the smart investor, to use it however you want to use it for. If you want to buy another property, if you want to fix up a property, if you want to pay down debt, it's keeping money in your pocket. And then going forward, he's still going to have $28,000 of depreciation each year. He would have had 40 if he didn't do cost seg. Now he's got 28, but he has an additional $324,000 in tax year 2019, and he probably won't use it all, so he can carry it forward to subsequent years.
Those are kind of the summary of the different types of lending. The main difference, community banks are generally smaller. You can get into 15 millions, but they're really not super comfortable in that level. And if you're doing a loan of that size, you might as well go agency or bridge. It really just depends on the relationship. This is the amortization you're going to see. Community bank is going to offer 15, 20, 25-year amortization generally. There are 30-year options out there. You can get a higher loan amount with an agency property than you previously had with the community bank. And due to the longer amortization, you can get a lesser loan payment. So again, agency is really the optimal financing type for multifamily if it's achievable. Community and bridge debt have the ability to not require an occupancy standard, meaning that you can go to community bank with a property that's 65% occupied physically or economic and still be able to qualify for a loan. You just have to prove to them that you can operate the property well enough to get it to where it can meet the DSCR. And the DSCR is essentially your NOI divided by your debt service, to see that if your NOI is 20% greater than your debt service, it's a 1.2. So they'll have DSCR requirements to qualify. So community bank and bridge debt, if you have a property that's not occupied at 90%, those are going to be your first two options to look at. Whereas agency, they do require a 90% occupancy, a physical occupancy. So agency debt, again, is the preferred option. It just you have to qualify for it. You have to check all the boxes.